Hi, everybody, and welcome to the Middle Class Investor. This is Seth, your host. What we got on the screen right here is the S&P 500, and what we're basically going with at this time is that we've had a bear market has started, and we've got a very deep retracement of that first move down. Now, let me say before we even get started. I mean, there's always just really two possibilities in the market, right? The market's either going up or it's going down. But if for some reason this market takes out these old highs, then this cannot be a retracement of a downtrend. That means the downtrend has not started yet. But for other reasons I've mentioned on this program, the market internals at these peak areas, advanced declines, bullish percent, bearish percent, things like that, basically indicate that this is a counter trend. Now, could that be wrong? Sure, it could be wrong. Absolutely could be wrong. So we just need to be aware of that. So if the market comes down here, like say, and then immediately takes off to the upside, well then obviously this isn't a counter trend in a new bear market yet. It means this was a wave 4, and we've still got 5 to go. And we've talked about that. We've talked about this potentially being like an A, B, C, D, E, and then this would be 1, and then A, B, C, 2. So this would be 2. So 1 could be here, 2 could be here, 3, could be going. 3 would probably take us, somewhere north of this pivot right here, and then 4 would come back a little bit, and then 5 up, maybe into this 3,000 area. So that's a possibility. But it's a lower, when you're looking at the market, what you have to think about is probabilities and weight of the evidence. And the weight of the evidence is for this to be a counter trend for the reasons I've already mentioned. So that's how we're looking at this right now. All right, let's look at the VIX real quick. So, hold on. So the S&P 500 was up for the week, but then sold off. So sometimes you get an increase in VIX when you have a candle like this, where the market opens up here, rallies way high, sells off, and then rallies a little bit toward the end of the week. Sometimes you can get a VIX that spikes a little bit, and if you look at the VIX, it really didn't do much of anything. It's just kind of bouncing along the bottom right here. So I would say right now the VIX is not telling us much of anything. It's kind of hanging around these lows here. Bouncing off this thing, rallying, bouncing off this thing. So the VIX, what I go to the VIX for is just confirmation of what the market is doing, and I think we have that there. All right, let's look at the short-term Treasury. This is what we look at to determine what the Fed's going to do, and it looks like it's we had this consolidation where nothing was happening for a while, and it started to curl up just a hair. So the consolidation was kind of right through here, right through this area. You can see right here, a few weeks ago it started to curl up some. So it's kind of got a small consolidation here. We should see this, continue higher as the Fed raises rates. Actually, this will go up before the Fed raises rates. This is kind of a predictor of what the Fed's going to do. The Fed, I've made made the case here several times. The Fed does not set interest rates. The Fed follows interest rates. So, people are kind of worried about the yield curve inverting. What yield curve inverting would mean is like short-term rates, go up faster than long-term rates. And I think what we're on the cusp of seeing here is both the 10-year and the 30-year are going to start taking off here, and we're probably not going to have an inverted yield curve. We're probably just going to have a 10-year and a 30-year that are just going to take off, and the 13-week Treasury, the 3-month or whatever, will be following along. In fact, some people point to the fact that the yield curve is not inverted as to why the market should continue going up. And, the reality is there's no causality between inverted yield curve and the market. I mean, there's been a lot of studies done by this kind of thing by people, and there's no definitive correlation between interest rates in general. Sometimes interest rates are going down and we have a recession. So there is no reliable indicator like that in the market. You have to look at the weight of the evidence. And one of the things I like about the Elliott wave model is it gives you a model that you can then kind of integrate other factors into, like we talked about the advanced decline line, these internals, commercials versus speculators, things like that give you clues as to what's happening in the market. Otherwise, you're just like, I don't know. I mean, the economy's doing good. I guess I should be in. I mean, that's the problem with not having some sort of methodology. All right, again, let's go back to the 10-year, because I've said before on here many times the 10-year Treasury is the most important interest rate in the entire world. And you can see here it looks like this kind of is like a little 5-wave move, 1, 2 to here, 3, 4, 5, and then we've got a pullback. A deeper pullback would have been into this area. We got a real shallow pullback. This looks like a 1, maybe a 2, or maybe 2 will pull back even further. Maybe this whole thing is, A, B, C, and we will get a deep pullback. But whenever this is done pulling back, we should see interest rates really take off. And it's going to be something to see. And the market's going to cause a lot of problems, because there's a lot of people on this short interest rate trade. They think the Fed, has this under control. Although I'm hearing more and more people talk about interest rates rising. So it's not as bad as the discussion was back in this area, where people just thought they were going to go lower and lower and lower forever. In fact, somewhere in here, like in this area here, Bill Gross, who's a very famous bond trader, basically called the bottom. He basically said the bottom in yields has occurred. So, but the yield curve thing, I think, is still, people are potentially wrong about that. So here's Germany. You can see Germany's a little weaker than the U.S. Japan also weaker, potentially. I mean, these could be ABCs. I don't follow these markets as closely, so I'm not looking at the internals and stuff in these markets. So these pullbacks could actually be countertrend. United Kingdom, I mean, all these markets look pretty much the same. It's really hard to see much difference between them. Okay, let's switch over to toss charts, and I just want to show you a kind of the count I'm working off of. A WXY is something known as a double zigzag in Elliott terms. It's just a larger ABC that are made up of smaller ABCs. And of course, the last leg in a WXY is made up of a 1, 2, 3, 4, 5, and you can see that here. And if this is the end of 5 waves, we should see the market probably this week pull back into this 2785 area, have some sort of brief rally the following week, and then really get going to the downside. So if it doesn't, and it turns and goes up and makes a higher high, well then clearly, you know, we've got some more bullishness left in the market. This whole thing was a 4 into this area, and this was well, into this area where this 2 is, and then we've started, you know, a 5th wave. Now, if you look at it on a really, you know, large scale, let's go back to profits and let's look at a 20-year chart. On the wrong chart here. Let me put it on the S&P 500 index. So, you know, if you look at it like this, where this is a 1, 2, 3, 4, 5, and then and let's zoom in on the last move up. This looks like a 1, 2, 3, 4, 5. So you can see how this could be a 5-wave move. But what we're saying is that that 4 occurred back here somewhere, right in this area, and then this was 5. So, I mean, from a symmetry standpoint, it does look like this is a 4, but right now what we're saying is the weight of the evidence, the internals at these peaks and these valleys, basically indicate that this is a counter trend rally. So we'll see. I mean, you know, sometimes you're wrong. I mean, in the market. In fact, I'll show you a chart. I've showed you these charts before from Deneric, who is a very good chartist. He uses the Wilshire 5000. Let's just show you his chart real quick. And you know, he shows just that. So he shows this 1, this flat for a 2, 3 into this area here, 4 to the 2016 low, and then 5, and then he shows where we're showing this is first move down in a bear market. He's showing this whole thing is a 4, a triangle 4. So 1, 2. What's interesting is this little 1, 2, 3, 4, 5 looks a lot like this one, except for that we didn't have a triangle here. We just had a simple zigzag ABC pullback. But so you can make the case. See, he's got 5, this being his primary count, and this alt 5 being the alternate count, and the Elliott wave people have it just the opposite. And I think one of the things that's driving their decision is when you start looking at some of these other charts. So, for example, if you look at the NYSE, this is the NASDAQ NYSE composite. These are very broad markets, and you can see that clearly we've got some sort of triangle here, and it's weak. It's not anywhere close to the top, which means likely this is a 2. You know, 1, 2, 3, 4, 5 would be 1, and then this A, B, C, D, E, you know, would be 2, and then 3 would be next. Okay, so that's the NYSE. If you look at the Dow, same thing. You got 1, 2, 3, 4, 5 down, A, B, C, D, E up. You can see it just pierced that trend line. Let me zoom in a little bit. You can see it just pierced that trend line, and right here exceeded it ever so slightly. But what Elliott, again, what they're looking at is they're looking at the weight of the evidence. Now, and the transports are saying this is a 1, 2, 1, 2. So, and by the way, we do have a Dow theory setup going on in the market, which is, it seems like we haven't had one in forever, but, you know, Dow theory is still valid. You know, it's not something a lot of people talk about, but when that setup does happen, it is valid. The other thing I think is interesting is that the NASDAQ has made 5 waves. So it's done. In fact, the NASDAQ Thursday and Friday maybe, kind of sold off, you know, like so. And it's already, you know, down into this area right here. And so anytime you have a sell-off after 5 waves, you at least go back to the wave 4 low, and then who knows, maybe you get some sort of A, B, C up, and then boom, 3 down. So the NASDAQ looks like it has topped, and you know, in 2000 the NASDAQ topped 5 months after the Dow and the S&P did, and it's looking like we have a similar scenario. I mean, the Dow's been in this consolidation since February, so that's 5 months. And the S&P, NYSE, and S&P have also been in the 5-month consolidation. So could be a scenario where it's very similar to 2000, where the broad markets top, you know, after the fact. And then you got other weight of the evidence, like Facebook and Twitter being down 20% in one day. I mean, those are serious moves. I mean, I think Mark Zuckerberg personally, his net worth decreased by like $15 billion in one day. I mean, that's a, you know, of course it's paper profit. That's what people always, oh, it's just paper profit. But then, you know, but the reality is they can write down those paper profits on applications for loans and things like that, which a lot of us, you know, smaller peons can't do, which is one of the reasons these rich people just keep getting richer and richer, is they gather these assets and then they borrow against these assets to buy other businesses, other revenue-bearing type of entities. So, and it's just really hard for the average person to leverage the banking system in that way. And of course, the thing that makes all this possible is the Fed and the constant inflation of the money supply. So that's a whole nother subject, but I just, you know, I feel, you know, it kind of came up in there, so I thought I'd bring it up. But so here's what we're looking at so far. If you look at gold, gold, I mean, it's showing a little bit of a, you know, we got a little bit of a hammer, almost a double hammer here. And I would say if gold breaks above 1235 next week, then I would be long gold. Likewise, silver. Silver is kind of broken out of this triangle consolidation, and you got kind of a hammer and a doji. And I would say if silver breaks above or closes above, say $15.50, I'd probably be long silver. Notice in this pullback, the reason I say that, the reason I talk about closes, so if next week we're looking at this, if we're looking at silver and we have a closed candle that looks like, whoops, sorry, didn't hit the wrong button, looks like that. In other words, a close is above this high. Here's the high here. We have a close above that high. One of the things I want you to notice is look in this pullback. Here's a high and a low, lower high, lower low, lower high, lower low, lower high, lower low, higher high but not a higher close, lower low, lower high, lower low, lower high, higher low, but not a lower close, not a higher close. And then, so these are inside weeks. Okay, this week was inside this week, and then this last week was inside this week. That's why I say if we get a close. Now it's not for sure. Okay, I want to make sure that everybody knows what I'm saying is not for sure. But if we get a close above this high right here, that is different than everything that's happened in this downtrend. Okay, it tells you, at least for the moment, that the buyers have overcome the sellers, and what's likely to happen is a trend reversal that'll start doing something like this to upside down. You might get a little this, and then turn around and do this, but this higher close, this close above the high of the low day, or the close above the high of the inside day, or inside week in this case, this is a bullish entry. So I just want you to keep that in mind when you're looking at a pullback like this. Start looking at the lowest days and inside days, and look for a close above either the inside day or the low day. And I think you'll find that those are great buying locations. All right, let's look at the euro. The euro appears to be somewhere in a wave 4 triangle consolidation, and what we know about that is that we should see the euro pull back into this area down here, at least below 1.15, but potentially down into the 1.14 area off of this pivot. So we have a pivot right here, and what we know about pivots is, generally speaking, there's an area below the pivot where the market likes to go to before it reverses, and that's what we're looking for on the euro. What else do I want to look at? We can look at oil. Let's look at oil. Oil has really surprised me that it's rallied this far, but it looks like maybe it's done. Just along the lines of what we were just talking about, if we get, you can see here we got this long candle. So this is the low week right here, and then this is an inside day or an inside week, and then this is inside of this week. So if we were to get a candle that looks like, this, gosh, I did it again, looks like this next week, where we get a close above this inside high day, so if we get a close above that day or that week, then potentially this downtrend is over, and you could see, oil begin to rally. Now it could just be counter trend, right? So you get a pullback like this, and then maybe a little rally up with a big spike up there somewhere, and then maybe a doji, something like a doji, and then something like that. Okay, and if that's counter trend, then of course what we know about that is that we're looking for that, a strong move in the third wave position to the downside. So, pay close attention to these low weeks and these inside weeks, because these are, again, great entries. Potentially, I mean, if this is through going down, then we know we're going to have some sort of counter trend rally. So you're going to be looking for this to then short oil to the downside. But if you're aggressive, you can also take the counter trend move up, and I would look for 50% to 61.8% retracement, and then I would step to the sidelines. I wouldn't try to go for a new high on this, because this is an important high. Anytime you have an important high and you have a move down or a move up from an important low, and you get a pullback and it's to a higher low or a lower high, you got to respect that. You can't just jump in and go, oh yeah, that's ready to go. In this case, that's ready to go higher. I think the odds are it's better to take a short position with a tight stop than it is to, after all this, after a 62% retracement, count on the fact that it's going to make new highs. That's just a lower probability scenario. Now, some people will say, well, but it's because it's an uptrend. That's a high probability because it's an uptrend. Yeah, but again, the wave principle gives you a context for which to view that, and if you're looking at 5 waves, then the probability of that trend, at least you're going to get some sort of pullback down into this area before this trend continues. So you just know probability wise, you're not going to watch it take off this bottom, go to 50%, trade sideways, and then go higher still. That's just not a higher probability situation. So hopefully that makes a lot of sense. I don't know if I've made that clear or not, but I do think it's worth pointing those things out. Now, right now, the E-minis, the S&P E-minis are down 8 points, and it's currently about 10 till midnight. So we'll see what it does in the morning. But again, I'm looking for it to come down into this area here below this low week, and that's because that's the 4th wave low. If you go to like a daily chart, or let's say an hourly chart, you can kind of see here 1, 2, 3, maybe, or 3's here, and then 4, and then 5. You can kind of see this looks like a 4 right here. So we should see this market pull back into here on the ES, which is around 2788. Could go right through that, but it'll probably slow down right there and trade sideways, maybe bounce a little bit. It could bounce to a 61% and then fall, or bounce to a 61%, fall a little bit, and then rally again. So again, the further out you're looking, the harder it is to predict the path. I mean, we can look on a very short-term basis and say, well, the path is likely to be this way or likely to be that way, based on certain fundamental characteristics of the trend and the wave principle. But the further you go out, the harder that is to predict. So anyway, I hope that's clear. That's really about all I have this week, everybody. I just wanted to mention, though, that our primary look is that the market is topped. We've had a move down, and we've had a deep counter trend rally. Now this can go all the way back to the high. It just cannot exceed the high and still be a wave 2. So if we do exceed this high from when was this? January 2018. If we exceed that high, then this has still got more to go to the upside. It's no longer a counter trend rally, and it's a 5th wave move of intermediate or primary degree. Okay. All right, everybody. That is it for this week. Thanks for coming in, and hope to have you come in next week. Take care. We'll see you later. Bye.